The 3% sell-off we saw yesterday is very likely buyable. Tom, you there?
Yeah, I'm here.
Why is it buyable today?
Now, I'm not saying COVID and coronavirus fears have peaked, but we had a 3% decline as markets are trying to cope with this at a time when we're not in recession and PMIs are still above 50. Since 1948, it's happened 47 times. 94% of the time we're higher. 6 months later, 90% of the time we're higher. 12 months later. This looks like a lot of bad news is attempted to price in, and that's why we think it's actually buyable here.
So what if I said to you, okay, well, how do you know that, number one? What if I told you in a month or two it's not contained, it's worse in the U.S., a recession appears like it may actually be likelier than it is today, PMIs are then below 50, that throws your whole thesis out of whack. And we're not talking about a far-fetched scenario that I've just baked up out of nowhere. There's a legitimate chance that that's the scenario we could be dealing with 2, 3, 4, 5, whatever months from now.
Scott, it's a reasonable concern, and I think that's what's trying to be priced into the markets. And as you know, the markets can't price a binary outcome, right? Like if we slip into recession, it's hard to discount that today. But I think what we have to keep in mind is there's a lot of reasons why U.S. stocks shouldn't be sold here, as Stephanie's been saying. You know, one, it is the global safety trade. Number two, you know, U.S. company dominance is going to rebound. And, you know, third, it's not a foregone conclusion that this does spread as a pandemic. And the reason I think that matters is, you know, if you're an active manager and, you know, more than half of our clients need to be invested, they can't not own stock. They have to find some way to be exposed. Even our macro clients can't go to 100% cash. So where are they going to find safety trades? So I think when we think about how markets reacted yesterday, it was, let's get out and reassess. Those 3% sell-offs are pretty rare. And if you look at the distribution of outcomes, how markets reacted 3 months, 6 months, 12 months later, 94% of the time, people regretted selling. I mean, I think that's really key, and that's why we think this is a viable moment.
But how can you suggest, though, that the prospect of a blow-up in U.S. cases is in any way priced in?
Oh, Scott, I'm not saying it's priced in. I'm saying it's difficult for the markets to price that in, but in that process, it's taken the air on the side of caution. In other words, I think what we've priced in is a greater than a 50% probability that it's spreading to the U.S., and that's why we've sold off so sharply. You know, we can see it in how the VIX is behaving, right? It's priced in a spike event that's up to 4 months out. So the derivatives markets has already priced in this continuing for several months. And we looked at, I think sentiment is going to show, when we look at retail sentiment, when it comes out Thursday, AI, that's my favorite survey, I'm sure it's going to show some massive, massive negative decline given the magnitude of the sell-off. And, of course, as many of you guys are saying, you know, the markets are pretty deeply oversold, so there's been indiscriminate selling.
What if I said, though, I'm not going to listen to Tom Lee. I'm going to listen to the bond market, and that is screaming that we've got a problem. And I told you what the 10-year was doing earlier today. I said the 30-year was extending its record low, and that's going to be my signal, not a strategist who's attempting to decide for me whether I think that the virus is going to get worse here or not.
Yeah, and I think the rates market, right, is telling us when you look at the levels, we should be scared about something. That's what the 10-year and the 30-year are saying. But what's interesting is if you look at the spread between the 10-year and 30-year, right, because to us that's always been a really good forward-looking indicator, that the spread between the 10-30, it's actually been steepening. So what it's saying is that there's a near-term shock here. Actually, the bond market is pricing a pretty sizable economic snapback in the future. So,
although you know, the other part of the curve is inverted again. So, I mean, it's sort of pick whatever place along the curve you want to make your case.
Sure, but you know, for the last 50 years, and we wrote about extensively, the 1030 has been a bulletproof business cycle signal. It has the fewest false positives of any point in the yield curve. and it has an 18-month lead time. So it's been steepening. So in a way, as corona fears have worsened and we'd expect a near-term shock, it's actually steepening, telling us that as bad as things can look, it's actually a high amplitude but short-term event. And I think, look, I'm not saying that this is not Spanish flu, but do I want to price that in today? It's, that's our point.